And welcome to the Post-Monetary Policy Committee press briefing from the Central Bank of Kenya. The MPC met yesterday, the 5th of February 2025, and as usual issued its statement that went out last evening. So we'll have our usual press briefing, which will be addressed by the chairman of the Monetary Policy Committee, who's also the governor of the Central Bank. You're free to participate by way of asking questions, and as is usual with us, please do so through the Slido app. That's www.slido.com. The meeting is hashtag MPC0225. So you put your questions there. Please ensure, and this is very strict from me, please ensure that you include your name and your institution as you're asking the question. And as usual, we'll concentrate on questions to do with the decision that was taken yesterday and from the MPC statement. But for now, I'd like to introduce and welcome the chairman of the Monetary Policy Committee, is also the governor of the Central Bank of Kenya, Dr. Kamau Thugge.
Thank you, Wallace. During its meeting on February 5th, 2025, the Monetary Policy Committee decided to lower the Central Bank CBR by 50 basis points to 10.75% from 11.25%. It also reduced the cash reserve ratio, the CRR, by 100 basis points to 3.25% from 4.25% to complement the lowering of the CBR and to support the lowering by banks of lending rates to the private sector. The Monetary Policy Committee noted that overall inflation was expected to remain below the midpoint of the 5 plus or minus 2.5% target range in the near term, supported by low and stable core inflation, lower energy prices, inflation, and also the stable exchange rate. The central banks in the major economies have also continued to lower their interest rates, but at different paces. The committee also noted that economic growth has decelerated in 2024, and therefore there was scope for further easing of the monetary policy stance to support economic activities while ensuring that the exchange rate remained stable. The reduction in the CRR will release additional liquidity to banks, and this is expected to lower the cost of funds and lending rates and support economic growth and credit, economic growth rising from increase in credit to the private sector. The committee observed that the CBR has been lowered substantially since the MPC meeting of August 2024, yet lending rates have only declined marginally. With these measures, banks are expected to take the necessary steps to lower their lending rates further to stimulate growth in credit to the private sector and support economic activities. To ensure that banks are implementing the risk-based credit pricing model, the central bank has embarked on on-site inspection of banks to ascertain that they are reducing their interest rates in line with the risk-based credit pricing model. Under the amendments to the Banking Act recently enacted by Parliament, any bank that has not passed on the benefits of reduced cost of funds to reduce their lending rates to the private sector will be penalized in accordance with the law. The MPC will closely monitor the impacts of the policy measures as well as developments in the global and domestic economy and stands ready to take further action as necessary in line with its mandate. The committee will meet again in April of 2025. In taking its decision, the Monetary Policy Committee looked at both the global developments as well as domestic developments. With regard to global developments and specifically with regard to inflation, the inflation rates in the major economies have declined, but core inflation rates have remained sticky, reflecting persistent services price inflation. The global food inflation has trended upward, and that can be seen in the headline inflation, particularly in the last 2 months, with the upward tick in the overall inflation. With regard to oil prices, these have moderated, although there is a risk of potential volatility rising from potential tariff increases and the continuing geopolitical tensions. However, going forward, we do expect oil prices to decline owing to an increase in supply by non-OPEC oil producers, but also OPEC plus producers are expected to start increasing production in April. At the same time, demand is muted, particularly from China, given its reduced economic growth. Again, the main risks here relate to tariff increases, but also disruptions from the ongoing conflict in the Middle East. With regard to food prices, the global food inflation has trended upward, and as of December was at 6.7, and this has primarily been driven by the edible oil prices inflation, which up to December had increased by 33.5%. Other inflation rates for sugar and also for cereals continue to be negative. Overall, global inflation is expected to decline in 2025 from 5.7 2024 to 4.2, and further to decelerate in 2026 to 3.5%. And this decline in inflation provides some headroom for further reductions in interest rates in the major economies, but at different paces depending on their inflation and growth outlooks. In terms of the global economic growth, we see some improvement from 3.2% in 2024 to 3.3% in 2025, and that growth is maintained in 2026, again at 3.3%. It's important to note that the U.S. continues to have a very resilient economy, with growth this year expected to be at 2.7% compared to 2.8% last year. We're also seeing some recovery in the United Kingdom and also Japan. And in terms of the emerging market and developing economies, China continues to have some difficulties. The growth is expected to decelerate to 4.6% this year, and further to 4.5% in 2026. India's growth continues to be very strong. Last year was estimated at 6.5%, and it is expected to sustain that growth in 2025, but also in 2026. The stronger growth outlooks in the US, Saudi Arabia, and UK in 2025 do provide scope for higher diaspora remittances, inflows, and also tourist arrivals to Kenya. And the projected pickup in growth for the Euro area and sub-Saharan Africa in 2025 should benefit Kenya's exports to Europe and also to Africa. So to summarize global developments, the global headline inflation has moderated, but the pace of decline has slowed down in major economies due to the stickiness in core inflation. Central banks in major economies have continued to lower their interest rates, but at different paces depending on their inflation and growth outlooks. This should improve global financial conditions and market access for emerging markets. The global growth is projected to improve to 3.3% in 2025 from an estimate of 3.2% in 2024, supported by strong growth in the United States and India, and improved prospects in the growth in the United Kingdom. Risks to the global growth outlook relate to elevated uncertainty on trade policy amid rising tariffs on imports and further escalation of geopolitical tensions, particularly the conflict in the Middle East and between Russia and Ukraine. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa, and emerging market and developing economies averages both in 2025 and in 2026. Turning to macroeconomic developments, the domestic macroeconomic developments, the core and non-core measures of inflation for Kenya, jointly developed by the Kenya National Bureau of Statistics and the Central Bank of Kenya, were launched last month, January 2025. Core inflation excludes products whose prices are highly volatile and transient, and therefore provides a more comprehensive measure of the underlying trend of inflation. In addition to overall inflation, the CBK will keep track of the core and non-core measures of inflation in line with global best practices in inflation targeting central banks. The introduction of core and non-core inflation measures also aligns with the East African Community guidelines on the computation of harmonized CPI in the region. The total core CPI basket comprises of 275 items with a total weight of 81.1% in the overall CPI, and is therefore a more representative basket and closely tracks the overall rate of inflation. So domestic inflation remained below the midpoint of the target range of 5 plus or minus 2.5% in January 2025, and this was supported by lower core inflation. Core inflation declined from 2.2% to 2%, and what increased the overall inflation from 3% to 3.3% was a pickup in non-core inflation from 5.2% to 7.1%. In terms of the contribution to overall inflation, as you can see from the right-hand panel, the core inflation has remained relatively stable. Its contribution has remained broadly unchanged since around October, and what has been driving the increase in overall inflation has actually been the non-core inflation. And for example, between December and January, core inflation, its contribution remained at 2 percentage points, but non-core inflation increased from 1 percentage point to 1.3 percentage points. With regard to core inflation, the decline in core inflation was mainly on account of lower prices of processed food and also alcoholic beverages. For the so those are the two key, and you can see the decline from 2.2 to in December to 2%. You can see there at the bottom, the main drivers for that reduction were the processed food items that declined from, their share declined from 0.2 to 0.1, and similarly for alcoholic beverages, a reduction from 0.3 to 0.2. With regard to non-core inflation, the main drivers are food crops and related items. These were the ones that mainly drove the higher non-core inflation. And within the non-core inflation, what really has driven the increase from 5.2% in December to 7.1% in January were the food crops and related items. And you can see there that the percentage, the contribution for the food crops increased from 5.9 to 8.2%, compared to the energy, fuel, and utilities, whose contribution actually was negative, was an increase negative from minus 1.3 to minus 1.8, and the transport contribution was only 0.7 percentage points. In terms of expectations looking forward, we did have an agricultural survey in January 2025, and most of the respondents to this survey expect some moderate upward pressure on overall inflation in the next 3 months on account of higher vegetables and cereals prices attributed to seasonal factors. Nevertheless, the respondents expect stability in palm prices, but also in the stability of the exchange rate. Our forecast for overall inflation going forward, we expect that even by June, the overall inflation will be below 4%, and therefore still below the midpoint of our target range. To summarize these developments on inflation outlook, the overall inflation remained below the midpoint of the 5 plus minus 2.5% in January 2025. The inflation rate increased in January 2025 mainly on account of a rise in non-core inflation due to seasonal factors. Core inflation remained low and stable, indicative of muted demand pressures, and the exchange rate stability has reduced imported inflation. Overall inflation is expected to remain below the midpoint of 5 plus minus 2.5% target range in the near term, and this will be supported by a low and stable core inflation, expected easing of energy prices, and a stable exchange rate. And the main risks to the inflation outlook relate to uncertainties in the evolution of international oil prices and the uncertainty of global geopolitical environment. Turning to the domestic economic performance and outlook, we have had to revise the growth for GDP in 2024 from the previous estimate of 5.1 to 4.6. Our estimate of agriculture continues to be strong both in 2024 and also in 2025, supported by favorable weather conditions, but also government programs such as the subsidizing of fertilizer. However, we see some challenges in the industrial sector. In 2024, for the first time in a very long time, we saw contraction in the construction sector in the second quarter and also in the third quarter. And therefore, we expect the industrial sector in 2024 to only grow by 0.4, just a very small increase. The services sector also slowed down in the first three quarters of the year compared to the year before, and therefore we are projecting services growth to be about 5.8%, and this is compared to 7% in the previous year of 2023 and also 2022. We also expect that the high interest rates during the course of the year did contribute to reduced credit to the private sector, and this also suppressed domestic production. And the combination of all these factors led us to revise the GDP growth to 4.6% in 2024. However, in 2025, we do expect a recovery and growth. We are projecting at 5.4%. And this is premised on continued resilience in agricultural production at 4.9% and a recovery in industry. And specifically, we expect a recovery in the construction sector to grow by 4.7% and also the services sector to increase from the 5.8% of last year to 6.3%. And this again is informed by the fact that we expect interest rates, commercial bank interest rates, to come down, and that should offer incentives for increased demand of credit by the private sector, and that should ultimately stimulate economic production and the services sector should therefore do better this year than it did last year when real interest rates were so high. Of course, we also expect the lower interest rates to stimulate construction in the private sector, and also we do expect now that the government will be able to spend more on development projects, and that's why we have projected some recovery in the construction sector. This is a demonstration of what happened to credit to the private sector in some of the key sectors. And you can see in the manufacturing sector, credit from the banks declined from an increase of 23% in December of 2023. And there was a continuous decline in expansion of credits to the manufacturing sector, and appears to have reached negative 14.3% before some recovery, although it's still negative by December of 2024. This again reflects both the appreciation of the exchange rate, the shilling exchange rate vis-a-vis the US dollars. Some of the loans to the manufacturing sector are denominated in foreign currency, and so the appreciation of the shilling also is reflected in this reduction in credit to the manufacturing sector. Similarly, you can see the transport and communication. Again, credit going there has been on a downward trend, as has been to the building and construction sector, and also to the trade sector. So to summarize developments on with regard to domestic economic growth, the performance of the economy slowed in 2024 third quarter, with real GDP growth decelerating to 4% in compared to 6% in the third quarter of 2023, mainly reflecting a slowdown across most of the sectors. Real GDP growth for 2024 is estimated at 4.6%, down from our earlier projection of 5.1%. And this downward revision is underpinned by deceleration in growth in most sectors of the economy in the first 3 quarters of the year. Private sector credit growth to key sectors of the economy, which has decelerated, and the contraction in the construction sector. Growth is projected to recover in 2025, with real GDP growth projected at 5.4%. And this reflects the robust growth of services driven by resilience of select sectors, the stable growth of the agricultural sector, expected recovery in growth of credit to the private sector, and improved exports growth supported by implementation of trade initiatives such as the Kenya-EU Economic Partnership Agreement. The outlook is subject to uncertainties in the external and domestic environment, including the rising tariffs on trade and persistent geopolitical conflicts, which could have potential impact on supply chains. Turning to monetary developments, growth in broad money supply moderated on account of the exchange rate valuation effects attributed to appreciation of the shilling. So growth in M3 as of December was actually a negative minus 0.2. Then that, of course, includes the exchange rate valuation effects. When we adjust for the exchange rate valuation effects, the growth was actually 5.2%. But of course, still, even after we have adjusted for the exchange rate valuation effects, there is a downward trend in expansion of M3. When we just look at M2, that is excluding foreign currency denominated deposits, we do see that there has been a recovery in expansion of M2, where by November it had increased by 7%, and by December it increased again to 7.1%. Looking at the growth in credit to the private sector, without including the exchange rate effects, we see that there's a contraction by the December of minus 1.4%. But if we adjust for the exchange rate valuation effects, the credit to the private sector grew by 3.1%, which is slightly higher than the growth that was experienced in November of 2024. Again, this is just a disaggregation of the credit to the private sector by currency. When we just look at the credit to the private sector denominated in foreign currency, we see that by December that had contracted by 11.4%, whereas the local currency loans had increased by 2.1%. And of course, now when you combine both the local currency loans and foreign currency denominated loans, you get that contraction of minus 1.4% in December. The short-term interest rates have declined further in line with the lowering of the CBR. And you can see that the 91-day Treasury bill, the 182 Treasury bill, and the 364 peaked at some point in around July and have all been coming down. The 91-day Treasury bill has actually declined from 15.8% to the current rate of 9.6%. Similarly, the 182 Treasury bill has also declined from almost 17% to about 10%. And then finally, the 364 Treasury bill has also declined from almost 17% to the current level of 11.3%. In terms of the commercial banks lending rates continue to increase through November and declined marginally in December of 2024. Here what we have is showing the average commercial bank lending rates at 17.2 in November, which then declined to 16.9% in December. We have also included the developments in overall inflation, and as you can see, the real interest rates, which basically is taking the nominal lending rate of commercial banks and deflating it or reducing it by the overall inflation, and that is the blue line that you can see has been going up for quite some time, and reached a peak of 14% in real terms, and then declined to 13.5%. And obviously, real interest rates at this level are very high, and very few businesses can really operate on this kind of high real interest rates. And that's why we have been pushing for the banks to lower their lending rates and specifically their real interest rates, so as to stimulate credit to the private sector. On the monetary policy implementation framework, the interbank rate continues to track very closely the CBR, and this has improved the monetary policy transmission to the short term through the short-term interest rates. To summarize the monetary developments, growth in money supply, in broad money supply, M3, moderated in December of 2024, mainly reflecting contraction in credit to the private sector, but also the exchange rate valuation effects. The growth of credit to private sector across most sectors has slowed down, reflecting the impact of the exchange rate appreciation on foreign currency loans, but also the high lending rates due to the lag effects of previous tightening of monetary policy, but also the slow reduction in the lending rates to the private sector. There has been the banks have not moved as quickly as to lower their rates as other rates, whether it is the TBO rates that we've seen that have reduced quite significantly and very quickly, and also the CBR, which has also reduced quite significantly. We have not seen the lending rates by commercial banks declining substantially. The short-term interest rates, particularly the interbank rate and the 91-day Treasury bill rates, have declined in line with the reduction in the CBR. And as I said, the commercial banks' average lending rates declined only marginally in December 2024. The lowering of the CBR and the reduction in the CRR from the Monetary Policy Committee meeting yesterday are expected to lower lending rates and support lending to the private sector in 2025. Turning to the balance of payments, this is a summary of the balance of payments. The current account in 2024 was projected at minus a deficit of $4.5 billion. However, this is fully financed by both the capital account and the financial account. You can see the financial account. These are inflows of 6.1 billion, and the estimated overall balance of payments for 2024 was about 1.5 billion surplus, and this is one of the highest overall balance of payment surpluses we have had in a very, very long time. And that surplus, when we include the disbursements from the IMF, which amounted to $1.283 billion, when we add that to the overall surplus, we have a buildup of our international reserves by $2.7 billion. So this $2.7 billion, we started the year, at least at the end of December of 2023, we started with gross usable reserves of about $6.5 billion, and we ended the year 2024 December with a level of reserves of $9.3 billion, and that is what is reflected here, that from the overall balance of payment surplus and the IMF disbursements. The current account deficit has narrowed in 2024 from minus 4% to 3.7%, and this has reflected a fairly good performance in exports, particularly horticultural exports. But we've also seen strong performance in tourism. We've seen strong performance in remittances, and we've also seen a reduction in the oil import bill. And this has contributed to this narrowing of the current account deficit. Going forward for 2025, we do expect some stronger recovery in imports, and therefore just a slight widening of the current account to 3.8%. But we do expect that over the medium term that the current account deficit would stabilize around the 4% of GDP. On regard to exports of goods, we are projecting a growth of 15.4% in 2024, and This is a very good performance compared to the contraction or reduction in exports in the previous year of 2023, when exports actually declined by 2.6%. This, for 2024, we expect an increase of 15.4 to be followed by another increase in 2025 of 12.3%. With regard to imports of goods, there we do expect a recovery in 2024, and we expect imports to grow by almost 10%. And again, this is a very strong recovery from the previous year of 2023, when actually imports declined by almost 11%. And as I said earlier, we do expect in 2025 a further recovery in imports. With regard to remittances, 2024 was a very, very strong year for remittances. They increased by 18%, and this is compared to the 4% that we experienced in 2023. Going forward in 2025, we have been a bit cautious in the estimation, and we have brought it down to 6.5%, but I suspect we will be able to do much better than that. But of course, that all depends on the global economic outlook, and particularly in those economies where we get a lot of remittances from, including the US, the UK, and of course Saudi Arabia. On tourist arrivals, the tourism sector continues to do very well. We now have almost 2.4 million visitors, and this was an increase of 14.6% over a very strong growth in 2023 of 40.8%. The usable reserves of the central bank, which I mentioned earlier, you can see that by 2024 it was the 9.3 billion that I mentioned. This is the highest level in nominal terms that we have ever achieved, and the only time the reserves were close, which was 2019 and 2021, was only because of the issuance of some Eurobonds that went up to build our reserves. Without those Eurobonds, the level of international reserves then would have been no more than 7 billion in 2019, sorry, and of course in 2021 it would have been 1 billion less, so around 7.8 billion. So the performance in 2024 is a very strong performance. It's based on the good performance in the current account. The only Eurobond that we issued was for liability management and did not go to use was not used for the build-up of our reserve position. In February, the reserve position continues to be strong, above $9 billion, and it's equivalent to 4.6 months of import cover. And this is a level that this is a buffer that it's adequate. It's also above our target of 4 months of import cover, and really with also a flexible exchange rate, it is sufficient for us to be able to deal with short-term external shocks. The exchange rate has continued to be stable since early last year, and has basically been between 129 shillings per dollar to about 130 for the last several months, and we expect this stability to continue. And as I said, the current account continues to perform well, and therefore we expect stability in the exchange rate to continue. To summarize the balance of payments developments and outlook, the current account deficit is estimated at 4.5 million billion, equivalent to 3.7% of GDP in 2024. And this is compared to a deficit of $4.3 billion, equivalent to 4.0% of GDP in 2023. And this improvement in the current account deficit reflects improved goods exports, strong diaspora remittances, and lower oil imports. The current account deficit was more than fully financed by capital and financial inflows, and this resulted in a very strong balance of payment surplus of US dollars 1.5 billion in 2024. And this surplus, together with the IMF disbursements, resulted in a buildup of international reserves of $2.7 billion, so that we could achieve the $9.3 billion at the end of 2024. The current account deficit is projected at US dollars 5.5 or 3.8% of GDP in 2025, and this is driven by imports of goods supported by a stable exchange rate, continued growth in exports, resilient remittances, and stable global oil prices. The current account deficit is expected to be more than fully financed by capital and the financial inflows, resulting in an overall balance of payment surplus even in 2025 of US dollars 591 million. The surplus, together with the expected IMF disbursements, is projected to result in a further build-up of our international reserves by US dollars 1.45 million. The main external sector risks relate to trade tensions arising from US tariffs, imposition of tariffs, the escalation of geopolitical tensions, and uncertainty and volatility in the international oil markets. On fiscal developments, the fiscal consolidation over the medium term should reduce debt vulnerabilities while moving the debt to GDP ratio towards a stronger, sustainable position. On the banking sector developments, the total capital adequacy ratio stood at 19.4% in December of 2024. This is an increase from 19.1% in October 2024, while the liquidity ratio increased to 55.8% in December 2024 from 54.3% in October. The capital adequacy and liquidity ratios were above the minimum statutory limits of 14.5% and 20% respectively. The gross non-performing loans to gross loans ratio decreased marginally to 16.4% in December of 2024 from 16.5% in October and 16.7% in September. The banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The cumulative banking sector pre-tax profits increased by 36 billion or 15.9% to 262.3 billion in December of 2024 compared to 226.3 billion in December of 2023. So to summarize the key takeaways, the global inflation is expected to moderate in 2025, while global growth is expected to improve, but uncertainties to the outlook are elevated. 2, the monetary policy measures implemented by the CBK have anchored macroeconomic stability. Overall inflation remains anchored within the target range. The Kenya shilling has remained stable, reflecting the narrowing of the current account deficit and improved investor confidence. This stability is also anchored on key reforms undertaken by the central bank to strengthen the monetary policy framework and to reinvigorate the interbank foreign exchange market. With the prevailing macroeconomic stability, the performance of the Kenyan economy is expected to pick up in 2025, with real GDP growth expected to remain above the global and sub-Saharan Africa averages. The CBK is building on the prevailing macroeconomic stability to support the government's economic growth objective, as reflected in the further lowering of the CBR and the reduction of the CRR by the Monetary Policy Committee to support lowering of lending rates by commercial banks and stimulate growth in credit to the private sector. Thank you very much.
Thank you. That's the governor, who's also the chair of the Monetary Policy Committee. And as you'd expect, there's lots of interest in the decision or decisions that were taken yesterday by the Monetary Policy Committee. So we'll go through a number of these questions and we'll take some of them as representative because there's quite a number that are touching on the same subject matter. Ramanyang from CGTN Africa, given how weak domestic consumer demand is, does the Central Bank of Kenya expect that the central bank rate and the cash reserve ratio cuts will be sufficient to revive credit growth without matching tax cuts? George Obulutsa from Reuters News is asking, what extent do you see the US freeze on foreign aid affecting dollar inflows to Kenya and by extension the foreign exchange reserves and the exchange rates? From this batch, the final one is from Julian Zamboko from NTV Kenya. 2025 is the first year for increase in core capital to 3 billion shillings. Any update on the 13 banks with a core capital below 3 billion shillings?
Okay, let me start with Mr. Ramanyang. Yes, we do expect the reduction in the CBR and the CRR to impact the reduction in lending rates by commercial banks. I think, as I've said earlier, the banks have not responded as quickly as they should have. But I do believe that since August, when we started to lower the CBR rate, we are now lowered the CBR rate by 175 basis points, and then including the 50 basis points from yesterday, that's 225 basis points. At the same time, the TBO rates have, as I indicated earlier, some have declined by actually between 600 and 700 basis points. Yeah, and I know one of the banks have given the explanation that they are having to offer high deposit rates so as to be competitive with their depositors who can access the treasury bills. But I think by now there must have been deposits that are maturing since we started to lower the CBR and since the T-bills started to come down. And if we just follow the risk-based credit pricing model, there is no reason why the lending rates to the private sector should not come down. And that's why we are saying let's do some on-site inspection of the banks just to make sure that indeed the banks are following up on this on the banking sector charter that we agreed upon, and if it's true that their cost of mobilizing funds has not changed. Well and good, but if it has, that reduction in cost of mobilizing deposits should be passed on to consumers and to borrowers, and should not be used to pad the profits of the commercial banks. So yes, I do believe that given what we have agreed in terms of the risk-based credit pricing, that the actions that we have taken to date should reduce the credit, should reduce the interest rates that banks are charging. I think once that happens, we should be able to see more demand either for consumer durables, but also for investments, and that increase in aggregate demand is what we are expecting would also stimulate economic growth, and for that reason we have increased the growth from 4.6% in 2024 to 5.4%. Obviously, if there are tax cuts, that raises, of course, that will increase disposable income, but that also raises other issues with regard to the sustainability of the fiscal position, whether that increases the fiscal deficit, and how that will take us towards a sustainable debt position over the medium term. There's a question from George on the U.S. freeze on foreign aid affecting dollar inflows to Kenya, and by extension the foreign exchange reserves and the exchange rate. We don't see much impact on the exchange rate from the freeze on aid. As I said, the reasons I've given for the strengthening of the exchange rate are mainly current account developments, and in particular remittances, which has been very strong. What could affect the exchange rate perhaps is if there is a significant reduction in remittances from the U.S., which we don't see that happening, or maybe at a very large increase in oil prices, which would increase our oil import bill, which also we don't see. So really, going forward, we do see our level of reserves remaining fairly strong, and we also do see the exchange rate remaining stable. Julian's Amboko, you raised a question about the increase in core capital. Any updates on the 13 banks with core capital below the 3 billion? Yes, for this first year, the banks are supposed to increase their capital by 2 billion, and there is indeed a number of banks that are below that. We have written to the banks to tell us about what their plan is to raise their capital all the way to the 10 billion, not just for the first year, but to the 10 billion. So we will be engaging the banks once we get the responses from the banks to see exactly how they are going to meet the capital requirements for this year, as well as over the medium term, over the next 5 years.
The second batch of questions will begin with Brian Goge from the Standard newspaper. Brian asks, actually they're related questions again. So how is the CBK conducting inspections to ensure that the banks implement the risk-based credit pricing model, and how many officers have been dispatched? Similar question from Jimmy Mbogo of Citizen. CBK says it has started physical inspection of banks. What prompted this action? How long has it been going on, and what have the results been so far? On a different matter, from Stella Stoakay of Standard Investment Bank, will the Central Bank of Kenya continue injecting liquidity to banks through reserve repos? and how will it ensure that the money actually trickles down to the private sector? Eric Mokaya and Douglas Munene. Eric is from Mwango Capital, Douglas is from DTB. Same question, how much liquidity will be released to commercial banks by the 100 basis point cut in the cash reserve ratio?
Okay, I think the question from Brian and Jimmy Mbogo are somewhat similar. As I said, we have started with the on-site inspections. I think we have staff now working on the. We've started with the 5 banks, and that should be completed within the next 2 weeks or so. Nobody has been fined yet. Obviously, we have to wait and see the results. But I think just to add that in the Business Laws Amendment Act that was enacted by Parliament just the other day, we have provided for penalties for non-compliance with the guidelines from the central bank. And I think in moving away from the capping of interest rates and coming up with this banking sector charter that we all agreed. In that charter, we also provided for remedial measures in the event that banks did not comply with the Banking Act, but also with that charter. And so legally, and what was amended in the Business Laws Amendment Act was to provide for penalties in the event that a bank benefits unfairly or by ignoring the guidelines from the central bank. So that is what we'll be using. Penalties have also penalties have also been increased from 2 million to 20 million, and there's a provision now to charge the banks by to the penalty to be 3 times how much the individual banks have benefited by. So if they benefit by 100 million shillings, they will be fined 3 times that, which is 300 million shillings. There's a question here about whether we'll continue to inject liquidity to banks through reverse repos. Again, we have a monetary policy implementation framework, and for example, now immediately the CBR has now been lowered to 10.75. So immediately we will be now doing the monetary operations. In this case, will be to inject a bit more liquidity into the system in order to lower the interbank rate to 10.75. So yes, reverse repos and other monetary instruments will continue to be used in order to align the interbank rate to the CBR going forward.
So from David Habling of Bloomberg News, Anna Nanjala Wekesa from the Kenya Times, Eric Mokaya from Mwango Capital, and Kefa Morori from the Nation Media Group. It's all sort of the same question relating around to a set of headlines that had been there a few weeks ago, which is about the Treasury possibly taking over government debt issuance by the Public Debt Management Office. All of the 4 had asked the same question. So in your batch 3.
Yes, I think there were some headlines which were, I think, based on what had been published by the National Treasury in terms of the medium-term debt management strategy. We have engaged with the National Treasury. We continue to have very good relations with the National Treasury. And I think there will be some revisions to that debt management strategy, which I think will be made public. The strategy has to be submitted to Parliament by February 15th, together with the budget policy statement and other documents. So I think I think what was submitted was more of a draft, not an agreed position. I think you'll have to wait and to see the revised strategy.
So thank you. So the final batch of questions, there's quite a number, but like I said, a lot of them seem to be related. So we'll just sort of take representative questions. So we start with Simon J here from Renaissance Capital, who asks, is there any concern that the Central Bank of Kenya may be cutting policy rates too fast relative to advanced economies, which may lead to outflows of capital? Jimmy Mbogo from Citizen again, is the Central Bank concerned about liquidity risks in any bank? And finally, Ramanyang from CGTN, what sort of IMF program is Kenya keen to get after March? Would a standby credit facility be an acceptable plan B if an ECF program is not viable?
Okay, I think on Mr. Njehia's question about concerns about cutting policy rates too fast, we actually are not that much concerned, and because we still feel that the interest rates on our bonds, even on our bonds, are still relatively high. And if you take into account the fact that we have a fairly stable exchange rate, those interest rates are still very, very high, and should be, and they should not result in an outflow of capital, because where would that capital go? It'd be going to other instruments that have a much lower return. So of course it's something that we always take into account when we have this kind of discussion, but we are fairly comfortable that at these levels and with a stable exchange rate, we won't see capital outflows that could substantially impact on the exchange rate or on our reserve position. Jimmy Mbogo asked about concern about liquidity risk in any bank. We don't have any concerns about liquidity risk in any bank. Ramanyang asked about the sort of IMF program, whether it's a standby credit facility as Plan B or ECF program is not viable. I think, Ramanyang, I think it's too early to say what kind of an arrangement we'll have with the IMF, but it's quite clear from the government side we would like to continue and have an arrangement with the IMF. What kind of an arrangement will be, I think that we'll have to wait and have further discussions with the IMF. But for certain, we want to continue our close relations with the IMF going forward.
So thank you very much. That brings us to the end of this briefing from the Monetary Policy Committee meeting of February 2025. And as we said, the MPC meets every 2 months, so we expect the next meeting to be in April of this year. So until then, please keep an eye on any other news and announcements we make from the Central Bank. But thank you for joining us this morning into the afternoon, and we hope to see you in April.